Hey everyone, welcome to Your Market Insight. Marcelo's in here. Now, there's been a lot of talk about something called SPACs recently, and we thought we'd just take a minute to kind of explain to you, what they are, why they're used, and why we think some of them are incredibly interesting. So, SPACs, it's a term thrown around, and what it actually means, they're special purpose acquisition corporations. It's basically it's like a big blank check. So the way that they're created is somebody is a sponsor, and they go out, they create this company, they raise a bunch of money. It could be 500 million, $1 billion, $10 billion. It doesn't really matter the amount of money that they raise, but they raise this money, and the company is basically just like a shell. There are no operations. There's nothing. There's just a bunch of money that was raised, and it becomes a public vehicle. Now, what has to happen is within 2 years of the SPAC being launched, they need to go out and actually acquire an operating business. And if they do not acquire a operating business within 2 years, then they actually have to return all the money back to investors. Now, why do people like using SPACs? Well, what a SPAC enables people to do is basically, bring a private company into the public markets with, what's a polite way of saying this, the minimum amount of due diligence possibly necessary. Normally if you take a company from private to public, then what you have to do is you have to go through a very, very cumbersome process with the Securities Exchange, with going on road shows and telling investors about your company and why you want to raise money and how you're going to go public and how you can make them money. And it becomes a pretty long-winded process to get through. It's not only time-consuming, but it's also very expensive. So a way to kind of short-circuit that is you create these SPACs, you go public, so you're a public company, you have oodles of cash, and then you just find yourself a company that you think is really good, and then you can acquire that company. And technically, you don't actually have to do anything besides very minimal due diligence, because the company is already public. Now, once the company is acquired, then obviously you have to go through the normal reporting processes and everything like that in order to make sure you fulfill all the securities regulation. But it is a far easier process to go public that way. Now, from an investor standpoint, from our standpoint, why are SPACs so interesting? And one of the reasons that they're interesting, and again, a big caveat, SPACs, they're not all good, just like anything else. Almost everything really depends on the jockey. So who's running the company, who's making the decisions, what kind of experience do they have? That's all incredibly important in terms of how well a company should do over time. And that also holds true with SPACs. So if you find what you believe to be the right SPAC, why is that particularly interesting? Well, for one, you've got a lot of downside protection, right? So when you're investing in something like a SPAC, you are paying something pretty close to what the cash value is on the books. You might be paying a small premium, but it should not be a huge premium to what the cash value is. Now, once a company is acquired, if you've got a really good manager in place with the SPAC, first of all, they should get the company at a good price. But then second of all, they're going to be able to have all this money in place in order to help this company grow. So if a private company is acquired at, let's say, 7 or 8 or 10 times earnings, well, once that company becomes a public company, then it's going to probably be revised to what is a more normal market multiple for that industry. So that, on the face of it, it could go from, let's say, 10 times earnings to a normal market multiple for that kind of business could be like 15 or 20. So you'd almost immediately get somewhere between a 50 and a 100% increase in the value of the underlying business as a shareholder, just based on this shift in valuation. Now, that's obviously not always the case. Some companies are going to be acquired at a much higher multiple, so there's going to be less upside. But generally, what makes it such an interesting, investment from our standpoint is you get this asymmetry. And like we said before, you're paying something close to cash for the business. If the business is acquired and it's a really good business, then it's going to, the market's going to give it a higher multiple, depending on what the fundamentals look like. And that could, without any kind of real changes to the underlying business, that could actually generate a lot of alpha for you as a shareholder. Now, if you get a really good manager, and there are some of those out there, if you get a really good manager, then on top of getting that multiple expansion, you can also have, the underlying business can perform a lot better. And that over the long term can generate even, far, far greater returns. So, long story short, we really like SPACs. We actually own a number of SPACs. We think that we have identified a number of exceptional managers, so we have invested in them, and we believe that we should do very well with those positions over the long term. So anyway, if you have any thoughts or questions, we'd love to hear from you.